Hello friends, today we wanted to speak about the new set of measures announced by the RBI governor today. The Indian fixed income market is going through a very volatile period. The lockdown has brought approximately 80% of the economy to a standstill. It seems RBI is tracking the economic and monetary conditions closely since there is this new set of stimulus measures announced today, which is within 3 weeks of the first one, which was on 27th of March. In fact, in today's announcement, RBI addressed specific funding lines for NBFCs, extended the moratorium on certain loans by the NBFCs, supported the state government's borrowing by extending its ways and means advances by approximately 60%, offering refinances to NABARD, CDB, National Housing Bank, and also targeted some long-term repo operations for NBFCs and HFCs. Let's walk through the possible economic repercussions due to the lockdown and try to figure out if the economic concerns are being addressed. The first problem, loss of earnings and income. This is being felt across corporates and individuals, and it is also expected to impact the debt repayment capability of many borrowers. RBI is trying to preempt the problem and potential rise in the NPL levels by offering a 3-month moratorium on all term loans. Today's relaxation around the recognition of NPA based on the 90-day norm is also a step further in the same direction, which is to reduce the potential rise in the NPA levels within the banks. This step obviously does not address the actual loss of income and earnings. Secondly, on a brighter side, the loss of income is expected to soften the demand and in turn pull down the inflation. However, we do not rule out some price shocks in the interim due to the supply chain damages caused by the lockdown, which can delay the softening of the CPI. But we do expect the headline CPI to move southwards over the medium term, despite some shocks in the near term. Government is attempting to address the loss of income to a certain extent, since they have come up with this 1.7 lakh crore of fiscal package to offer a safety net to the poor citizens by offering cash directly into their bank accounts and also food and maybe insurance as well. However, the government is silent as of now about how this additional spending is to be funded, particularly when the tax collections are expected to slip due to the lockdown. RBI has been prompt in announcing slew of measures in order to alleviate the conditions exacerbated by the COVID-19 pandemic. While the repo rate has been reduced by 75 basis points, in addition to several other liquidity infusion measures, the reverse repo rate has been reduced by a cumulative 115 basis points and presently stands at 3.75 in the last 1 month, including the recent 25 basis points additional rate reduction today. Interestingly, the reverse repo rate is the operative rate during this period of surplus liquidity. The spread of pandemic coronavirus has affected the Indian economy too. We do expect both the growth and inflation to slow down sharply over the next few months. After the lockdown is lifted, the date is always a bit uncertain. We do not expect the economy to return to its previous state of motion in the immediately or anytime soon. We would expect a slew of additional large fiscal and monetary stimulus to get the economy out of the trouble. While there has been a sharp rate reduction, we feel that there is room for more. We conclude that the bond prices seem to be far from pricing in the entire rate reduction so far, since the liquidity infused by RBI has not been invested into assets and remains idle in the form of cash and getting invested at the reverse repo rate back with RBI. The banks are averse to investments at this stage. With the decline in the reverse repo rate, the banks may at some point in time move away from deploying the surplus liquidity in the low yielding reverse repo and start investing into productive assets. We do expect the surplus liquidity to eventually be invested in sovereign bonds and AAA credits in the absence of credit demand. So what is our recommendation for investors at this stage? Our recommendations are two. The first one, get invested now before the yields move lower. While RBI has reduced the rates by cumulatively 210 basis points from February 19 till now, the bond yields are yet to price in the entire rate reduction. Recommendation number two, get invested in debt funds with portfolio duration slightly longer than your individual investment horizon. This additional duration will potentially help in overcoming the risks of a declining income and stay safe at home and stay safe in your investments and remain invested in high credit quality assets. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.